Looking to launch or expand your business? Securing funding is key. Explore 10 diverse business funding options tailored to entrepreneurs. From traditional bank loans and SBA financing to innovative avenues like crowdfunding and venture capital. Each option offers unique benefits and considerations. Whether you're seeking flexible lines of credit, equity partnerships, or grants, understanding these avenues can empower you to make informed decisions that align with your business goals. Discover how each funding option can propel your entrepreneurial journey forward. Today, we will talk about 10 business funding options for entrepreneurs. So before we start, make sure to hit the like button and subscribe to my channel. 1. Small Business Administration Loans. SBA loans are popular among entrepreneurs due to their favorable terms and competitive interest rates. These loans are partially guaranteed by the U.S. Small Business Administration, which reduces the risk for lenders and makes it easier for businesses to qualify. SBA loans can be used for various purposes, including working capital, equipment purchases, and real estate acquisition. The application process typically involves thorough documentation and may take longer than other loan types. 2. Bank loans. Traditional bank loans remain a staple for business financing, offering fixed or variable interest rates depending on the lender and the business's creditworthiness. Banks often require a solid business plan, financial statements, and collateral to secure the loan. While bank loans can provide substantial funding, they may have stricter eligibility criteria and longer approval processes compared to other options. 3. Business lines of credit. A business line of credit offers flexibility by providing access to funds up to a predetermined credit limit. Entrepreneurs can withdraw funds as needed and pay interest only on the amount borrowed. This option is ideal for managing cash flow fluctuations, covering short-term expenses, or seizing opportunities for growth. Lines of credit can be secured or unsecured, with interest rates varying based on creditworthiness and lender terms. 4. Equipment financing. For businesses needing to purchase equipment or machinery, equipment financing provides a targeted funding solution. This type of financing uses the equipment itself as collateral, making it easier to secure compared to unsecured loans. Terms typically match the expected lifespan of the equipment, and borrowers can benefit from tax deductions on interest payments. 5. Invoice financing. Accounts receivable financing. Invoice financing allows businesses to access funds tied up in unpaid invoices. Lenders advance a percentage of the invoice value, usually 80 to 90%, and collect the full amount from customers on behalf of the business. This option improves cash flow by accelerating receivables and can be particularly beneficial for businesses with slow-paying customers or seasonal sales cycles. 6. Venture capital, VC. Venture capital is a form of equity financing provided by investors or venture capital firms to high-potential startups and growing businesses. In exchange for funding, VCs typically receive equity ownership and influence in the company. Venture capital is suitable for businesses with scalable business models and substantial growth potential, but may involve relinquishing partial control and meeting stringent growth milestones. 7. Angel investors. Angel investors are affluent individuals who provide capital to startups and early-stage businesses in exchange for equity ownership or convertible debt. Unlike venture capital firms, angel investors often invest their own funds and may offer mentorship or industry expertise along with financing. Entrepreneurs can benefit from flexible terms and less stringent requirements compared to institutional investors. Angel investors typically invest in sectors they have experience in or are passionate about, aligning their investments with their personal interests and expertise. This alignment fosters a deeper level of engagement and commitment, benefiting both the investor and the entrepreneur. Furthermore, angel investments often come with more flexible terms and less stringent requirements compared to traditional institutional funding sources, such as venture capital. This flexibility can be advantageous for early-stage startups that may not yet meet the strict criteria of institutional investors. However, securing angel investment requires entrepreneurs to effectively communicate their business vision, market opportunity, and growth potential. Building relationships with potential angel investors through networking, industry events, and personal introductions is crucial for gaining access to this form of funding. 8. Crowdfunding. Crowdfunding platforms allow entrepreneurs to raise funds from a large number of individuals, the crowd, through online campaigns. Types of crowdfunding include reward-based, backers receive a product or service in return; donation-based, contributions without expectation of rewards; and equity-based, backers receive equity in the business. Crowdfunding can validate market demand, generate buzz, and provide initial capital without debt or equity obligations. Equity-based crowdfunding offers backers a stake in the company in exchange for their investment, making it a popular option for startups seeking larger funding amounts and strategic investors. This model democratizes investment opportunities, allowing everyday individuals to become shareholders in promising ventures. Crowdfunding campaigns require compelling storytelling, transparent communication, and effective marketing strategies to attract backers. Successful campaigns often tap into niche markets, leverage social media, and offer attractive incentives to backers. Moreover, crowdfunding fosters community engagement and brand awareness, creating a loyal customer base from early supporters. However, entrepreneurs should carefully consider the time and effort required to manage a crowdfunding campaign, as well as the legal and regulatory implications associated with raising funds from the public. Despite these challenges, crowdfunding remains a powerful tool for entrepreneurs to kickstart their ventures, validate their ideas, and gain momentum in the competitive marketplace. 9. Peer-to-peer (P2P) lending. Peer-to-peer lending platforms connect borrowers directly with individual investors willing to lend money at competitive interest rates. P2P lending bypasses traditional financial institutions, offering faster approval times and flexible terms. Borrowers create profiles outlining their funding needs and creditworthiness, and investors choose loans to fund based on risk and return criteria. 10. Grants and government programs. Entrepreneurs can explore grants and government programs designed to support specific industries, demographic groups, or regions. These funds do not require repayment, but often come with stringent eligibility criteria and application processes. Examples include Small Business Innovation Research (SBIR) grants, economic development grants, and state-specific incentives aimed at fostering business growth and innovation. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.